Okay, so for those that have been here for a while, and I see some of those names as well, um, just bear with us. Some of this might be some review, but we'll take it nice and slow. So let me give you a 30-second high-level explanation of how I kind of look at things. All right, sound should be fine for everybody. So I come from the trading side of the business, from the institutional trading side of the business, starting my career on the floor of the Chicago Mercantile Exchange. I've never had much exposure, or I when it comes to technical analysis and fundamental analysis, and all the conventional technical and fundamental analysis and all that stuff. While I know all that stuff, I've never really paid too much attention to it as far as using it, and there's reasons for that. Kind of real quickly, if you think about any conventional technical analysis chart pattern or strategy, they're all breakout entries. All the strategies and all the price patterns and pictures have you buying after a rally in price and selling after a breakdown in price. I'm sure most people have heard the term head and shoulders top, right? Well, if you follow the rules of the conventional technical analysis, then you'll know that the head and shoulders top, for example, has you shorting after a pretty significant drop in price, right? Just like a triangle breakout to the upside, for example, or a double bottom. If you're following the rules of the textbooks, right, all the technical analysis books out there, you're buying after a pretty big rally in price and into a breakout, okay? I've never had an interest in doing that because that stuff's never made sense to me. I've also haven't come across people that have been successful doing that stuff. So even though it's in all the books and everything else, doesn't mean it's necessarily right for you, okay? So the reason I say that is because when you think of strategies that have you buying after a rally in price, breakouts, and things like that, think about it. These are markets that we're trading here, these Forex markets. These markets are like this, like all the other markets that out there. We're looking at Forex charts right now, but we would we could be looking at the chart of your favorite food at the grocery store, and we would handle it the same way, right? Let me ask you this. If you have a favorite food at the grocery store, and imagine, think about what that is, something you buy every week that you must have. Maybe it's ice cream or something, right? Now, imagine that now next week you go to the store and that your favorite ice cream is now on sale, half price, okay? Now it's on sale, half price. What are you going to do? You're probably going to buy extra and throw it in your freezer, right? Okay? Right? So, again, how we buy and sell things in every other part of our life, most of us are pretty much, if we're smart shoppers, we're looking for deals, we're looking for ways to buy things low at cheap prices, and if we sell things, we want to sell at high prices, right? Okay? If you think about conventional technical and fundamental analysis, that school of thought has you doing the exact opposite, okay? So I'm here today to show you a way to do much better than that, all right? When I started, again, starting on the institutional side, you get a first-hand look at how to do it the other way, right? In other words, instead of using conventional technical and fundamental analysis and buying at retail prices and selling at wholesale prices, that's what consistent losing traders do, right? The consistently profitable market speculator, right? Many of the institutions out there, what they do on a daily basis is buy at wholesale prices and sell at retail prices, okay? Right? I see some people typing in words for the word confirmation. You have to be careful with that word. That word is an account killer. That will kill your account if you don't use it the right way, okay? If you're waiting to see a period of buying before you're interested in buying, that's novice confirmation in my opinion, okay? So let's take a look. For those who were with us last session, let me blow up this daily chart of the U.S. dollar, okay? So let me blow that up for you here. Sorry about that. Didn't realize I didn't have the mic on. Okay, so the last time we were in session here at FX Street, we took a look at the U.S. dollar. Okay, here's a daily chart, and we had this supply level up here. We had this level planned out up here. Since then, prices have hit that level and turned. At the same time, we planned out a nice long position in the euro. Okay? So nice job to those who took that trade and understood it, but let me blow this up and share it with you. Can everybody see that chart okay? All right. Here we go. You know, Windrunner, that's a great question, and I'll be completely honest with you, Windrunner. I used to be paranoid of stuff like that. You know, if you've ever read any of my stuff, you'll see in the early days, many years ago, I wrote very little, and I didn't say a whole lot when I was writing. And over the years, I've become a lot more loose and free with the information. And again, it's not that this is like some rocket science, secret magic algorithm. It's all very simple, actually. But the reason why I'm not worried about what you're writing there is because I've learned over the years you can hand this stuff to people on a silver platter, and still most people will not do it because they're just taught so different. They follow conventional and fundamental analysis and fear and greed and all that, and that always has them buying high and selling low, right? Anyway, let's move on here. So the best thing that I can do for you, the best lesson that I can kind of give you today is market timing. How to time the turning points in the market, right? The ability to identify market turning points before they happen. Here's a live example of one that we planned out last time that worked out. It's working out pretty well. But let me show you exactly how we did it, all right? We're going to focus right here. Now, when I started my career on the floor of the Chicago Mercantile Exchange, okay, I saw three things every day and three things only. Prices moving, people trading, and orders coming into the market. All right? Now, when you learn the markets from that perspective, without any books or any charts or anything else, you see that this whole thing is fairly simple. It's simply an order flow game, right? It's all the movement of price is simply a function of this ongoing supply and demand equation. Okay? And because again, taking orders from institutions, banks, money managers, hedge funds, that was my job for a while. Okay? I take these orders and then I would, when I'd organize these orders, according to price, putting the buy orders to my left and the sell orders to my right. Remember, each stack was according to price. So if I wanted to know where, let's say in a given day, I wanted to know where the market was likely to stop falling and begin to turn higher, I'd simply look down and to my left and find the largest stack of buy orders below current price. If I wanted to know where the market was going to stop rallying and begin to turn lower, I'd simply look up and to my right, or just to my right, and find the largest stack of sell orders above current price. That was real demand and real supply in the market. Okay. Now, that was my first impression with this industry and all that. The good news here is that all that was done in the beginning, at least in the early days, that was all in the Forex futures. Okay, the biggest market I watched for a long time was the Japanese yen. This is way before the euro. You know, we used to work the Deutschmark. Everybody remember the Deutschmark? Things like ancient history now. Probably dating myself even saying that, but yeah. Okay. So Alex is asking a great question here. Do you still have access to order books? No, Alex, but I don't think you need that. I think you'd be wasting your time with that, and I'm going to share with you. Okay. And Gillian, I see what you're saying. We don't have the novelty, unfortunately, of seeing the orders. You do. Okay. We're going to show you right now. All right. And Steve, yeah, we're gonna get to that. We're gonna talk about that right now. Let's jump in. Okay. All right. So I would argue. Okay. Now here's the downside to seeing all the orders. Let's say you're a big bank, right? Let's say you're a big bank. Let's say you're an institution. You're seeing a lot of orders, but you're only seeing your orders. Okay? You're not seeing everybody else's orders out there. Where's the one place that we can really see everybody's willing demand and willing supply? There's only one place. It's the price chart. Okay? So let's take a look. Now let's focus on this yellow area. The goal here is going to be to quantify supply and demand in this level. Okay, and I'm going to give it to you the same way we gave it to you last time, before prices got there, only this time we'll explain it a lot deeper. Okay, so how can we know, first of all, how do we know that supply exceeds demand here? Well, first of all, okay, Janetta, that's the beauty of this. You don't see false orders here. We're not looking at we're not looking at bids and offers, right? I don't look at that. Those aren't real, okay? All right, so prices drop from this level right here, okay? When prices are trading in that yellow area, I don't know whether they're going to drop or whether they're going to rally, right? No, nobody really does, okay? And I don't care. I'm not trying to predict this drop in price right here. That's the whole point. Make sure you understand that. I'm not trying to predict this drop in price. Instead, let me just grab this again. There we go. Instead, we want to let prices fall away from the level, okay? I want to let prices drop away or rally from this level. But the fact that they drop from this level, okay, that tells us objectively that supply exceeds demand at the level. Remember, the only reason why prices drop as they do from this level is because supply exceeds demand here, okay? Don't worry about the news or anything else. All that stuff comes after the fact. So prices drop. That's when we can wrap two lines around this level, okay, based on a very specific set of rules. We want to carry that level forward. We want to know where the real sellers are, where that big stack of sell orders is on the trade floor that I was talking about earlier, okay? Now, that's part of it. But here's the thing. How do we know how out of balance supply and demand is here? Maybe behind the scenes there's a small imbalance, or maybe there's a big imbalance. How do we know if we don't see the orders? Okay? How do we know? Well, there's a lot of things we can look at that help give us that information. First of all, number one, how prices left this level. Okay? Let me just write that right on the screen for you here so you'll have it. Okay? There you go. All right. So how did prices leave the level? What we're focused on there, okay? So what we're focused on here is looking at this part right here. There was a strong drop in price. Understand that prices can move away from this level in one of three ways. It can be a gradual drop in price away from the level. It can be a stronger drop in price like this away from the level. Or price can gap away from the level. Out of those three choices, which one represents the strongest supply and demand imbalance? Probably the gap, right? Okay, exactly, yeah. Good job. So we don't have a gap here, but we have the next best thing. It's a strong move in price away from the level. That suggests supply and demand are out of balance in a big way here. So the moral of the story is there. The stronger price leaves the level, the more out of balance supply and demand likely is at the level. Okay? So now, let's add another one. Remember, you can see all this stuff on the chart. It's all here. The big thing is if you know what you're looking for, okay? Time. How much time, but hopefully everybody can see what I'm writing on the screen here. So how much time did price spend at the level when it was there? Are there like 10, 15 candles in this cluster of trading? Or are there maybe, I don't know, 3 to 6 or 7 candles in here, something like that, right? So number 2 really goes hand in hand with number 1. The fact that price did not spend a lot of time here. Okay. Tick charts would be the same, Joe. Any type of chart you're going to look at the same way. Okay. So the fact that price did not spend a lot of time here suggests supply and demand are out of balance in a big way. Now again, that goes completely against what all the textbooks say. Most of the textbooks will say, look for a price level with lots of congestion, lots of activity, heavy volume, right? How many times do we hear climactic volume and all that stuff? How many times you see people, they're just when it comes to the Forex market, they think they're at a big disadvantage because they don't see volume, right? They all want to see heavy volume and so on, right? Anyway, if you think about it, the opposite is really true. And don't take my word for it. Just think of simple logic through, and I think you'll get it. If supply and demand is out of balance in a big way, right? If there's a big supply and demand imbalance, okay. Yeah, exactly, Jake. I think if I'm reading it right, yeah. So think about it, and go ahead and answer this if you want to. And don't worry, I'm going to keep trying to read back. Think about it. The more out of balance supply and demand is at a price level, okay? Is price going to spend a lot of time there or a short period of time there? Okay. Yeah, Forks, any time frame. Yeah, short period of time there. Okay. Therefore, if price is going to spend a little amount of time there, that's going to equate to few candles on your screen and very low volume. Okay. So be careful about believing everything you read. All right. So given that price did not spend all that much time here and you had a strong move away from the level, that suggests a pretty big supply and demand imbalance at the origin of that drop. All right? So let's see. Believe me, I wish I could say that I had some high level kind of algorithm that was a big secret. That's just not the case, right? If I did, I could probably package it up and sell it to the highest bidder out there, some big institution. But that's just not the case. This isn't rocket science. But all this is showing people what they do on a daily basis when they buy and sell things in every other part of their life. This is what it looks like on a price chart if you're doing it the right way. Okay. All right, so let's take a look at another one. Here we go. Again, just like anything else in life, if you're going to buy and sell things, you need a profit margin, right? Okay, so let's go with profit margin here for number 3. Let me recapture. And then once we get through this, the plan was to go start looking at some other charts and plan some other things out. Okay. So profit margin. So what we're looking at there is there's a couple things. Let's look over to the right here, and let's take a look at this area right here. Okay, let me put a circle on here. And I'll grab the chart again. There you go. So as price is returning back to the level for a short entry right here in the US dollar, or buying the euro, whatever you're going to do. Okay. We want to know where the nearest opposing demand level is when we're looking at this supply. Okay. Right. So when the price is rallying up for a short entry here, where's the nearest demand level? Okay. So we look at that rally in price. Well, there's a couple areas here. Notice we have our little drop-based rally demand there. That doesn't look like a big deal, but we have a much more significant area down here with a level sitting just below it, kind of right here. Okay. So ultimately, while we are in a little bit of an area right here, I wouldn't be that surprised if prices came back down to the low 80s at some point here in the future, right? Okay. So profit margin. And the last one I'll share with you, there's a few more, but we obviously can't go over everything in this short period of time. And also, too, for those, we have the trading room, the XLT program, an online trading academy, and if we went over 100% of the strategy in, the free webinars and free articles, the people in the program would send me hate mail and probably some bombs or something. So we don't want that. But we'll give you plenty here to get you going in the right direction. So take a look. Look at number 4, right? How far did prices leave the level before returning back up to the level, right? Okay. How far did prices leave the level here before returning back up to the level? Okay. Now, this one is going to mainly focus on probability. It helps with profit margin, but let's talk about probability. Let's associate this one with probability. The farther price moves away from this level before returning back to this level, the better, the higher the probability, the trade, right, or the opportunity. Okay. The reason is because, remember, one thing we haven't talked about, we've talked about how to quantify the supply level, right? And the opposite would just be demand. But there's a part 2 to this. It's understanding who is on the other side of your trade. Okay. If you have ever come across any consistently profitable trader, okay, you'll realize that a big focus, one of their biggest focuses is, and what they're really good at, is the ability to find novice market speculators, to know exactly what a novice market speculator looks like. Think about it. If you've ever been in has anybody here ever had a career in sales or something in retail? Anybody? You ever sold anything for a living, or you kind of been in kind of the retail business? Yeah, probably a few people, right? So who do you make the most money from, right? When you're selling something, what's the one thing, when you're selling something to someone, what's one thing you don't want them to really know, right? What's the one thing you don't want your clients to know, or be good at, when you're trying to sell them something? Cost is definitely a big thing, right? Yeah. So I guess I'm kind of saying the same thing. You don't want them to know, right? You don't want them to know the real value of what you're selling them, right? I know this sounds so bad when we talk like this, but it's the real world. So let's just deal with it. You're going to make your most money selling something to someone who has no idea what the real value of that product is worth, right? Okay? Or your cost, or profit margin, or anything like that. Okay? If there's one thing that a car dealer always says to you at some point, they say, we're not making any money on this sale, right? Giving it to you at cost. We're actually losing money on this deal, right? How many times you hear that when you're buying a car? Sure, right? Anyway, I think you get the point there, okay? The goal of the person selling you something is to convince you that it's worth more than you paid for it, okay? All right? So, what I'm getting at here is we want to be able to identify those people on a price chart, okay? And the good news is it's very easy to do that, right? Okay? It's not that difficult to do that. Because the consistent losing trader, the novice market speculator who doesn't know how to quantify the real value of something, always makes two mistakes. So the two mistakes that the consistent losing trader makes, the novice market speculator who you want on the other side of your trade, they make two mistakes. Mistake number one, they buy after a period of buying. Okay? Right? Look at it, they're buying after this big rally in price. So that number 4 thing we were talking about, not only is the buyer who's buying here buying after a rally in price, they're buying after a huge rally in price. Not a smart thing to do. You would never do that in any other part of your life and be successful at it, right? You'd never walk in the grocery store and when you find that, no matter how good that ice cream is, let's say it's $2 a box for the container of ice cream, no matter how good it is, you're never going to walk up to the checkout counter and say, oh, this ice cream's so good, I know it's only $2, but I want to pay you $5 for it, right? You're never going to do that. So don't do it here. Mistake number 2. The buyers right here. Now we're focused on these buyers specifically. They're buying after rallying price, and they're buying right into a price level where supply exceeds demand. The laws of supply and demand guarantee that you will lose taking that action. Therefore, we want to be the seller to the buyer here, like we were with the U.S. dollar. Okay, all right. And if we're wrong, we're placing protective stop just above the area to ensure a small loss. Okay. So, quantifying the supply level, rally, base drop, that's the picture that represents where the real sellers are in this market. Number 2, identifying the 2 mistakes that the consistent losing trader or novice market speculator makes, and then just taking the other side of that trade. Okay? And then, of course, to take the reason why we went over, we'll call these odds enhancers, these 3 or 4 odds enhancers we went over. There's a big important reason why we go over those, and it's this: what the odds enhancers do. Okay, 2 things. They allow us to see through these candles and understand the order flow that's going on behind the scenes. That's really responsible for the creation of the candle, right? Okay. Now, the important things that they help us do is now, let's say we find 10 levels on a chart, okay? What happens is, once you run through these odds enhancers and apply them to the different supply and demand or support and resistance levels you see on a chart, okay, what's going to happen is, out of every 10 levels you find, probably only 2 or 3 are going to meet your minimum criteria, and the other
7 or 8, you're not even going to pay attention to. You're going to ignore them. Okay? All right? So Donnie's bringing up a great point here, and let's talk about that for just a second. Okay? Okay. Donnie says, but is this good to go against the big uptrend? Okay. Now, two things that some people will say once in a while. Sometimes someone will say, you know what? But it looks like you're just trying to pick tops and bottoms. You know? And my answer to that is, well, of course. That's exactly what we want to do. We want to find a low price and a high price, right? We're not going to get every top and bottom, but that's the goal, isn't it? That's how you attain the low risk, high reward, and high probability entry. The second thing, conventional technical analysis. Let's talk about trends. Someone just brought up trends because here, if you look at the short we planned out last time in the dollar, it looks like we're breaking like the golden rule of trends, right? We're selling in an uptrend. Okay? Well, here's the thing. And that comes from the conventional technical analysis school of thought. All right? What I'm getting at is, first of all, when does every uptrend end and downtrend begin? It happens at a supply level. Where does every downtrend end and uptrend begin? It happens at a demand level. Okay? Now let's think about this though. So conventional trend analysis, the way that everybody looks at trends, okay, is most people they follow what the books say and they look for higher highs and higher lows. Okay? Okay. Jose, there's plenty of levels that come up in plenty of different markets, and plenty of time frames. Okay? All right? This is just a big picture chart we were looking at, but we'll look at plenty more. Okay. So let's talk about that. So higher highs, higher lows. Now, according to the books, how many higher highs and higher lows do you need before you have an uptrend? How many do the books say? Anybody? When it comes to identifying a trend, someone's saying 2. I think most of the books say 3, yeah, right? 3, yeah, a lot of people are saying 3. Okay. So most of the books say, everybody looks for that same picture. 3 higher highs and 3 higher lows. And once you have that picture on the chart, okay, 2 to form an uptrend, okay, 2 is fine too. So whatever it is, it's either 2 or 3, I guess depending on the book. So once you have 2 or 3 higher highs and 2 or 3 higher lows, what are you supposed to do? What are you supposed to start doing? What's the rule then? Yeah, you're supposed to buy, right? But don't buy before that, right? Okay, you're supposed to be buying. But let me ask you this. What has a group of traders already done before you if you're waiting for that picture? They've bought, right? Okay? A lot of buying has to happen to create that picture. But here's kind of the main thing. Why the people that have bought to create those higher highs and higher lows, why does it always have to be somebody else? Why can't it be you? Wouldn't you like to be a part of that invitation that goes out to the masses that says, hey, it's, we have higher highs and higher lows. It's now okay to buy. Come on and jump in. Wouldn't it be nice to be in the position already? Okay. Right? So, anyway. Alright, so anyway, I think you get the point there. Okay? So, let's move on. Alright, let's take a look at a different market, and I'll try to keep reading back and addressing anything. We'll keep those up there. So at the same time the U.S. dollar was hitting that supply level, we can see, and I'll capture the chart again down at the bottom. Okay. So Ash, let's assume that I see what you're saying there, and I know you're kind of half joking, half serious, right? But if we all would agree with you that you're not a bank, we're small fishes, right? We're small fish. Okay. If we agree with your comment there, then I would
that would cause me to want to be in the trend early even more. Because the longer we wait to buy into a move that's going up already, the higher the risk and lower the reward. You get the point? Okay. All right. Okay. All right, so let's take a look. So so this euro chart right here, let me just grab it. And let's see. Yeah, so at the same time the U.S. dollar was hitting supply, the euro came down right down into just the opposite picture of the dollar. Drop, little base, and strong rally, right? Okay, and we've since been bouncing out of that. Okay. Okay. Yeah, and Janetta, the truth is, I don't even know that it matters that we know which group is doing what. I mean, the chart just what's the difference? Like, who, you know what I mean? Like, we just want to know where the real buyers and sellers are, and anyway. Okay. So Paul's asking about Bollinger Bands, as you see up here on the hourly chart. One kind of the coin strategies that we use in Online Trading Academy. I forget. I don't know exactly where it's got its name. It kind of started in the options XLT program, and they call it the All-Star entry. And what that is with the Bollinger Bands up here. Okay. All that is the same concept that we just talked about with the supply and demand levels, but we're adding Bollinger Bands to that. So if price is piercing an upper or lower Bollinger Band and hitting a supply or demand level with a significant profit margin associated with it, then that just becomes a kind of a higher odds trade. All right, there we go. So we can take a look at another market. Another example of that, if you want to type in a market, I'll look at it while you're doing that. This is one we've been going over quite a long time in FX Street, the Aussie, right? I think we've had this level pegged. We've had this level in FX Street for about a year in the Aussie dollar. We can take a look at a different one though, and that one's been working out fairly well. Let's see. So, Janetta, you were first. Let's take a look at. All right, so let's take a look at the British pound, and let me re-grab screen here. Okay, there we go. And Janina, you choose. Are we looking larger time frame or smaller time frame? What are we going to plan here? 1 hour. We want to look at the 1 hour. No problem. Okay. All right. Let's take a look. Let's blow up this 1 hour chart here. Now, one thing we always want to do that we'll do very quickly here with anything we look at, we always want to start with the larger time. Okay. We want to start with the larger time frame and see where we're at. All right. So right now we're pretty far down on the supply-demand curve. If we look at this big monthly chart here, right, and we've just come off this drop-based rally demand level, right? Again, this is the picture that represents where the buyers are, right? Okay. So close to demand in the bigger picture, but let's take a look. Okay. So if we want to plan out a trade given that information in the larger time frames, okay, we see we rallied quite a bit off of that level. Okay. And now we're up into this area for a second time. So I'm going to put a horizontal line in here. And let me scroll left, and let's see what we have over here to the left that we're coming into. Okay. Let me get rid of this other line up here. That's a supply level that's pretty far away. Okay, so if you could see the chart here, okay, when I scroll left, we see that where we're at now is kind of in line with these two pivot highs here. So I'm going to go just above that, and you know what? For the purposes of scrolling, if it's okay,
let me go back and let me change this to like a 180-minute chart. Then we won't have to scroll so much. I don't want to confuse everybody. Okay, all the information we need will be here. Here we go. We'll refresh the screen for you. So looking at current price. Now let's just keep it real simple here before we go look for any other levels. Looking at current price, 149.76. Okay, and then looking left, right, and up, and then looking at current price and looking left and down. From this point right here, where's the path of least resistance? I'm saying like right now. Is it up or is it down? What would you say to that? Okay, so it's probably 50-50 up or down. Okay. Well, one thing we have to be careful of is, price is into this kind of little supply area right here, right? Okay. Now, we've been here before, so I wouldn't consider this a strong level by any means. All right. And when we look down and to the left, we see we have this area right here below, right? So supply, demand. There's maybe a little speed bump of demand right in here. Okay, but if we're taking the extremes, the drop-based rally that we associate with demand and rally-based drop that we associate with supply, here's our levels. So some might argue that the path of least resistance is lower. But let's put a horizontal line here and let's see what we have to the left, because the level we're in right now, I would not consider that a very fresh level. So let's scroll left. Okay, and when we do, we see we come into these tops here, which we're not interested in. Remember, price has been here a number of times. So the high odds short is probably not there. But when we get into this area up here, okay, here's our best level in the chart, which is right here, but that's pretty far away. But before that, okay, I would really be watching kind of this area in here. Okay? Remember, this is a start. Now follow my logic here. Okay? Oh yeah, I'll refresh. So this is the start of a drop in price right here. And watch, when I scroll right, you'll see that since price left that level, it has not been back there yet. So while price can certainly fall from where it's at now, okay, the higher odds short may be right up in here, about 150, right around 151, just a little bit before 151. Okay, and given that it's the British pound, okay, that's not all that far. But again, because of when we look directly to the left, let me just draw this in precisely for you, so you'll have it. Give me just a second. I'm drawing this in, and then I'll refresh the chart for you. There you go. So remember, given where price is at right now, the path of least resistance, okay, looks to be lower. The only caveat here is this is not the first time into this level. So we like taking the first pullback into levels. That's ideal. That's high probability. Okay. The nearest fresh level on the upside is just under 151. Okay. So that's kind of how we would look at the British pound. Now, looking at the clock and knowing that we don't have that much time left, I wanted to share with you the Swiss. Okay, especially in the bigger picture. Okay, this thing's in a downtrend, and I know all that. But when we look at the bigger picture of the Swiss, we see that we're kind of coming into the two little areas where we might be interested buyers in the Swiss. Let's take a look. Okay, we have two little levels sitting right on top of each other, and let me share this with you. Okay. A little bit lower. This is a longer term type trade, but it doesn't have to just be. It doesn't have to just be longer term. It can be, once you get down into either of those lower, those yellow areas. If I were a day trader, I'd be trading to the long side in those areas. If I were a swing trader, I'd be looking to trade to the long side in those areas. Okay. Okay. Jose, I would. That's it's market makers and retail traders, right? Okay. right? The banks have their orders in the right areas, right? The banks that do well. Okay. You know, how do you think the spread is determined, right? Now it's a computer system that's determining the spread when you buy and sell into the forex market, right? For different brokers, but how do you think it's determined? It's all determined by the order flow. You think they care about any news or anything else? You ever wonder why the spread gets wide at a real supply and demand level, right? Do you ever try to buy at a real demand level, a good demand level in the spot forex market, and all of a sudden the spread gets really wide, right? Why do you think that is? Okay, it's because they're not good. If you're going to try to stick the broker with the loss, they're going to make you pay for that. It's going to cost you something, right? Okay. Yeah. So, Boyke, what time frames? I can tell you all of my short-term trading, day trading, is done either in the Euro futures, the Yen futures, or the S&P futures. That's like 99% of my day trading. Done in one of those three markets. Okay? Alright. For longer term stuff, I include, plenty of other markets. Okay, let me try to read back here. Just remember, the thing you have to add to this when you're doing short-term trading, kind of to that last question there, is the added work for short-term trading is you have to know where you're at in the bigger picture, right? If you see a nice buy setup at a demand level on a 5-minute chart in the euro, for example, you have to go to the larger time frame. Make sure you know where you're at. What if on the daily chart at that point you're right up against larger time frame supply? Well, that buy setup on the day, on the 5-minute chart is probably not going to work. Okay, right? I would go up a couple time frames. All right, right. And let me do one other thing here. Hang on, just a sec. There we go. All right. So what I did was I just typed my email address in there. Okay. Right. There it is. It's sseiden@tradingacademy.com. You should have that in there. There it is. Okay. Alex, you have to be careful of those drop-based drop and rally-based rally, because those are always going to be found in the middle of moves. So be careful with those. That's why, when we trade, we want to trade out at the extremes. Okay? So that's why the pattern of drop-based rally and rally-based drop, that forces you out at the extremes. You could do the other, but you have to be very careful. Okay? Because those are going to be found in the middle of moves. Okay? All right? Okay. Yeah, and if of course, if you ever want to take this stuff a lot deeper, we do have the programs at Online Trading Academy. That's where I do all my stuff, both in the class and in the live trading rooms in the XLT. So hopefully that was helpful. This is all meant for your benefit, and you can send me an email if you have any other questions. I'm pretty caught up on emails. All right, and have a great day, everybody.